Your credit score is not about being responsible, it is a formula. Stay until the end where I answer the 3 most common questions about this. The lender tool. Your credit score was built in 1989 to predict payment risk for lenders, not to grade your financial responsibility. That one distinction changes every decision you make about it. The 3-digit cost. A 620 versus 760 score on a $300,000 mortgage costs about $200 more per month in interest. Over 30 years, that is $72,000 paid to the lender for the exact same house. The formula unknown. Most Americans know the credit score exists, but cannot name all 5 factors that determine it. The formula is entirely public. The education around it never has been. The wrong focus. Payment history is only 35% of the formula. The other 65% involves 4 factors most Americans have never once optimized. The invisible impact. A credit score affects loan rates, apartment disruptions, insurance premiums, and job offers. Most Americans never connect all 4 to the same 3-digit number. The starting invisible. The credit system requires history to issue a score and a score to grant credit. Most beginners never learn the 3 entry points that break this loop. The report versus score. The credit report is the raw record of every account and payment. The score is a number derived from that report. Fixing the wrong one first is one of the most expensive beginner mistakes. The score range FICO scores run from 300 to 850. The best rates, lowest premiums, and easiest approvals began at approximately 740, a specific target most Americans have never been told. The multiple scores. Americans have dozens of credit scores across FICO versions and Vantage Score. The number on a free monitoring app can differ significantly from what a mortgage lender actually pulls. The monitoring gap. Most Americans only check their credit score when applying for something. By that point, it is too late to improve it for that decision. Question number 1. What are the 5 factors that make up the credit score formula, and how much does each one actually matter? The 5 factors: payment history, 35%, amounts owed, 30%, length of history, 15%, credit mix, 10%, new credit, 10%. Most Americans only actively manage the first one. Payment history, the largest factor at 35%. One 30-day late payment can drop a score by 60 to 110 points and stays on the report for 7 years. Amounts owed. Credit utilization is 30% of the score. Stay below 30% for standard results. Below 10% produces the highest possible impact on this factor. Length of history. 15% of the score based on age of oldest account, newest account, and average age of all accounts. Closing old cards permanently reduces this factor. Credit mix. 10% of the score rewards having both installment loans and revolving credit. Most Americans have only one type and have never been told the other matters. New credit. 10% of the score is affected by every credit application. Each hard inquiry drops the score 5 to 10 points and remains on the report for 2 years. The 3 bureaus, Equifax, Experian, and TransUnion, each maintain a separate credit file with potentially different scores. An error at one bureau does not automatically correct at the others. The score models. FICO 8 is most widely used for general lending. Mortgage sensors use older FICO versions. The free score on Credit Karma uses Vantage Score, which can differ significantly from your mortgage score. The negative timeline. Negative items stay on credit reports for 7 years from first delinquency. Chapter 7 bankruptcy stays for 10. They reduce the score every month throughout that entire period. The positive foundation. Positive payment history on open accounts stays indefinitely. Closed accounts with positive history stay for 10 years. Consistent long-term payments are the most durable credit asset available. Question number 2. What are the most common ways Americans are unknowingly losing points on their credit score? The utilization spike. The statement balance, not the payment, is what bureaus report. A $3,000 balance on a $5,000 limit is 60% utilization, even if paid in full the same day. The card closure trap. Closing a credit card reduces available credit, raises utilization, and drops average account age, all at once. Most Americans think it helps. It almost always hurts, sometimes by 20 to 40 points overnight. The authorized user. Being added to another person's card lets their full account history appear on your credit report. If they have strong history and low utilization, you gain score points without applying for anything. The hard inquiry cluster. Every credit card or loan application creates a hard inquiry, dropping the score 5 to 10 points. Multiple applications in 1 month signal financial stress and compound the damage. The rate shopping exception. Mortgage, auto, and student loan inquiries within a 14 to 45-day window count as just one inquiry. Most Americans never use this protection because they do not know it exists. The collections damage. A $50 collection account can drop a score by up to 110 points. A forgotten gym membership or medical copay can block a mortgage approval for 7 full years. The zombie debt. Debt past the statute of limitations can still be pursued by collectors. Any payment or acknowledgement can restart the clock in some states and extend the negative reporting timeline. The credit limit request. Requesting a higher limit on an existing card improves utilization without opening new credit. Some issuers approve this with only a soft inquiry that leaves the score completely untouched. The rent reporting gap. Rent is most Americans' largest monthly payment, but it is not counted in standard credit scoring. Rent reporting services can add that history to your file, a real boost for renters with thin credit. The medical collection change. In 2023, the 3 bureaus voluntarily stopped reporting paid medical collections and balances under $500, and that still stands. A 2025 rule meant to go further was blocked in court, so unpaid medical debt over $500 can still hurt your score today. Question number 3. What are the exact moves to build, repair, and maximize a credit score starting right now? The free report. Every American gets a free report from all 3 bureaus at annualcreditreport.com. Checking your own report is a soft inquiry with zero impact on your score. The dispute process. Errors on a credit report can be disputed directly with the bureau online. They must investigate within 30 days. Successfully removed errors can improve your score immediately, no payment required. The on-time automation. Set every recurring payment to autopay at the minimum due. This prevents 30-day late payments from ever appearing on the report and protects 35% of the formula permanently. The utilization target. Keep total utilization below 30% always, and below 10% for maximum impact. Pay down balances before the statement closing date because bureaus see the statement balance, not the payment. The secured card start. A secured credit card requires a refundable deposit that becomes your credit limit. One small purchase paid in full each month builds positive payment history within 6 months. The credit builder loan. Credit unions offer loans where the money sits in savings while you make monthly payments. After the term, you receive the funds and gain documented on-time payment history at all 3 bureaus. The utilization hack. If one card carries a high balance, spread it across multiple cards to lower per-card utilization. Per-card utilization factors into the score separately from total utilization, and both matter. The age protection. Never close your oldest credit card unless the annual fee cannot be waived. It anchors the 15% credit history length factor. Occasional use keeps the account active and protected. The score milestone. Set 740 as the target. It unlocks the best mortgage rates. Identify which single factor is furthest from optimal and fix that one first for the fastest improvement. Learn the formula. 5 factors, specific weights, public rules. Learning this formula costs nothing. Not knowing it costs thousands across every loan, every rate, and every door it silently closes. If you found this helpful, consider subscribing to stay updated with our latest videos.